Hello and a warm welcome to all learners from Concepture Academy. Today we are diving into one of the most exciting topics in the world of business, how companies find the money to grow, expand and bring their ideas to life. You know, every business, whether it is a small startup or a large corporation, needs funds. But where does that money come from? That's exactly what we will uncover today as we explore the different types of financing for the business, from owners' own investments to borrowed capital, and how each choice shapes the future of a company. Before going into details of type of financing, let's start with bit introduction of financing. Financing simply means arranging money to meet business needs. Money can be arranged from two sources, internal and external. A business can use its own funds or raise money from outside sources like banks or investors. When business use its own funds, it is called internal financing, and when outside sources are used, it is called external financing. So let's look deeper into each concept one by one. Internal financing means using money that is already available within the business or from the owner's own resources. First one is profit retained. Instead of distributing all profits as dividend to shareholders, a business may keep part of its earning to reinvest in the operations or to buy equipment or expand. So this is one of the most common and cost-effective financing sources because the company doesn't have to borrow or give away ownership. Number two, sale of assets. Sometimes business sells old, unused or non-core assets such as machinery, land or vehicles to raise money. This frees up cash without taking on new obligations. Number third, owner's personal funds. In smaller businesses, the owner may put in personal savings or family contributions to finance the company. This shows commitment but also carries personal financial risk. So the big advantage of internal financing is that there is no repayment obligation or loss of control, unlike external financing. However, it may not be enough if the business needs a large amount of capital for the growth of the business. Let's have a look on external financing. External financing means raising funds from outside the business. Unlike the internal financing where money comes from within the company, here business approaches banks, investors or the stock market. So let's start with borrowing or debt. This is when a business takes loans from a bank or financial institution. It could be in the form of a term loan, bond or overdraft. The company must repay the loan with the interest amount, and that is useful because the company keeps full ownership. But the burden of repayment can create financial pressure if profits are low. The second type is issuing shares or equity. A company can sell part of its ownership to raise money by issuing shares, and investors who buy these shares become shareholders. So unlike debt, the company doesn't have to repay the money, but it does share profits in the form of dividends and ownership rights with the shareholders. The third method is venture capital or angel investors. New or growing businesses, especially startups, may not qualify for bank loans. In this case, venture capitalists or angel investors provide funds in exchange for equity or future profits. They also bring expertise, guidance and networks that help the business grow faster. So the key advantage of external financing is that it provides large sums of money that is needed for expansion. However, it may involve repayment pressure in case of debt or loss of some control in case of equity. So we just saw that external financing can be done either by borrowing money or by issuing shares. So to understand it better, let's break it into two main types, debt financing and equity financing. These are the most common and important methods business uses to raise funds externally. In case of debt financing, a business borrows money and promises to repay it with interest. Examples include bank loans and bonds. The advantage is that ownership remains with the business, but the risk is the obligation to repay regardless of profits. While equity financing means raising money by selling parts of the company to investors, in return, investors get dividends and ownership rights. The benefit is that the company doesn't have to repay like debt. However, it reduces the owner's full control on the business. Here I would like to mention another third option that is a very interesting type and called hybrid financing. As the name suggests, it's a mix of both debt and equity features. For example, convertible bonds are bonds that a company issues as a debt, but later the bondholder has the option to convert them into company's share. So they start as a debt but can become equity. Similarly, preference shares act like equity because they represent ownership, but they also behave like debt because they usually guarantee fixed dividends just like the interest payments on the loans. So hybrid financing is very useful because it gives business a flexibility. They can attract investors who want regular income like debt while also offering growth potential like equity. So it's often used when companies want to balance the risk and cost of financing. Once we know the different sources of financing, the next question is which one should a business choose? Businesses don't just randomly pick debt or equity, they must carefully weigh several factors, including cost of financing, risk level, control, and business stage and needs. Debt may seem attractive because interest is tax deductible and sometimes cheaper than issuing shares, but if the interest rate is high, debt can become very expensive. On the other hand, equity doesn't need repayment, but dividends or profit sharing can reduce the owner's earnings. Debt increases financial risk because loans must be repaid even if the business is not making profits, and too much debt can lead to bankruptcy, while equity reduces repayment pressure but brings in new owners which change the dynamics of the business. If we talk about control, when business raise money through equity, it gives up part of ownership and decision making. So founders may prefer debt if they want to keep full control of the business. When we talk about the business stage and needs, startups might be relying on the equity or angel investors because banks hesitate to give them loans. Mature companies, however, may prefer debt since they have steady cash flows to pay the interest. So the decision is really about balancing cost, risk, control, and growth stage. And the right mix often changes as business grows. Let's quickly recap. Financing can be internal or external. Internal financing is using on profits or funds, while external financing includes debt, equity, and hybrid form. Each has pros and cons. So let's apply the concept. Imagine you are starting a bakery and you have three options: using your own savings, taking a bank loan, or selling shares. What type of financing are these? Write your answer in the comments below and I will pin the correct answer later. That's the end of today's lecture on types of financing for a business. I hope this helped you understand how businesses raise funds and the factors that affect their decisions. So must check your concept by the activity I have given on the last slide and check the comments for the correct answers too. And yes, subscribe to Concepture Academy and follow us on Instagram and Facebook so you don't miss the next lecture. So let's keep learning together.